I trust everyone is safe and well. My name is Clint Harding and I'm a partner at Arnold Block Liebler and I head the Sydney taxation practice. And I'm very happy to be presenting the third webinar in our webinar series, Quick Takes on Tax. Firstly, welcome to all of our overseas guests and of course all of you situated in many parts of Australia who are tuning in today. We pay our respects to the traditional owners of this land and their leaders, past, current and future, with whom we can walk together in a movement of the Australian people for a better future. Before I introduce our speakers, some further housekeeping. Your video, audio and the chat function will not be enabled during this session. You will not be visible to anyone else on the webinar. We will address and hopefully leave some time for questions at the end. And if you have any questions that you'd like to send through, please use the little Q&A button at the bottom of your screen to type in those questions during the course of the presentation. And I will moderate those questions and put them to our presenters as time permits at the end. So now to the topic of the day. As we mentioned last week for those who tuned in, March 1979 saw the first major changes to Division 6 of Part 3 of the 1936 Act, the first major changes since its introduction prior to World War II. A lot of really good things came out in 1979. The Dukes of Hazzard TV show made its debut and triggered a resurgence in the demand for denim. McDonald's introduced a Happy Meal, and My Sharona by the Knacks was #1 on the charts, just edging out Do You Think I'm Sexy by Rod Stewart. Equally as important as any of those things, but perhaps not as much fun, and certainly not as sexy as Rod Stewart, was the introduction of Section 100A into the Income Tax Act Assessment Act 1936. As many of you will know who are tuned in today, Section 100A introduces several novel concepts which must be explored and understood. These include the concept of a reimbursement agreement and the notion of an ordinary family or commercial dealing. Now, if my family is anything to go by, then what is an ordinary family dealing may surprise some people. When I was just a young fella, my dad once gave me a piece of black floor linoleum and told me it was licorice, and he's still laughing about it some 40 years later. But on a serious note, to take us through these provisions, I have great pleasure in introducing our presenters today. In order, Kaitilin Lowdon, a senior associate in our Melbourne tax team, and my partner and friend and the leader of our national tax practice, Paul Sokolowski. So both Kaitilin and Paul, who will be well known to many of you, have extensive and recent experience on this topic. So without further ado, Kaitilin and Paul, let's have a conversation about Section 100A. So over to Katie first, I think.
Thanks, Clint, although I'm not sure I should be thanking you for raising Happy Meals at 12 o'clock on a Wednesday when I've got to sit here for the next hour or so, or a bit less than. So as Clint mentioned, we're going to take you through 100A today. We'll take you through the provision itself to start with, before working through a few case studies and indicate what we understand the current ATO view to be, and also what our view is in relation to the application of 100A in those case studies. And then we'll look towards the future and what's in store for 100A, and in particular in relation to a possible ruling that the ATO intends to issue on the application of Section 100A. So let's jump straight into it. I think if we are talking about 100A, we really need to start by going over Division 6 without really delving into its detail too far. But as many of you will know, the ordinary operation of Division 6 is that it's designed so that the trustee won't be taxed on the income of the trust, but rather it's a beneficiary who's made presently entitled to income who will ordinarily be taxed on the net income of the trust. Now, of course, there's exceptions to that general proposition, such as when liability might be imposed on both the trustee and the beneficiary because the relevant beneficiary is a non-resident. And of course, if there's no presently entitled beneficiary, then the trustee is assessed on the net income of the trust pursuant to Section 99A. However, as a general proposition, Division 6 is intended to operate in a way that deflects the tax liability away from the trustee and to the presently entitled beneficiary. So what Section 100A does is it disrupts that scenario for the purposes of the Act. It doesn't do so for for the purposes of general law, and that means that the beneficiary will always remain presently entitled to the income. It's only for the purposes of the Act that it disrupts that scenario. As Clint mentioned, Section 100A was enacted in 1979 in those dark days of the bottom of the harbour schemes. And it was designed as a specific anti-avoidance provision and was Parliament's reaction to the schemes of those days. And that's always a really important thing to remember, that background and history to the enactment of the provision itself. So what the provision actually provides is that where, apart from the operation of the section, a beneficiary to a trust estate who isn't under a legal disability is presently entitled to a share of income of the trust estate, and that present entitlement to the share or part thereof of income arose out of a reimbursement agreement or arose by reason of any act, transaction or circumstance that occurred in connection with or as a result of a reimbursement agreement, that presently entitled beneficiary will be deemed not to be and never to have been presently entitled to the relevant trust income. So it deflects the tax from the beneficiary presently entitled to the income of the trust. And it does so by deeming that present entitlement away from the beneficiary. In essence, what the provision is really saying is that we have a statutory sham. And if Section 100A operates, we're left with that worst case scenario of the trustee being liable pursuant to Section 99A. If the relevant beneficiary that was made presently entitled to income had losses, the trustee doesn't get the benefit of those losses. Nor can one rely on any default beneficiary clause. As I said, Section 100A only deems the beneficiary not to be presently entitled for the purposes of the Act and not more generally. Now, some of the kickers in relation to Section 100A is that it's a self-executing provision, and this means that when you're preparing a tax return, you have to consider whether Section 100A applies, and if it does, self-assess on that basis. In addition, there's no time bar in relation to the application of Section 100A. So if the Commissioner determines that Section 100A applies, in theory, he could go back and issue assessments to the trustee in perpetuity, or at least back until 1979. Now, it's worth considering that in the context of a lot of other anti-avoidance provisions in the Income Tax Assessments Act. So, for example, Part 4A does have a time bar. It's a very draconian provision. And what we'll see as we work through the elements is it can be quite difficult to discharge the onus in proving that Section 100A doesn't apply. So what then are the elements of 100A? And really there are three. There must be a presently entitled beneficiary to trust income. There must be a reimbursement agreement. And there must be a nexus or a link between those first two elements. So if we look a little bit more detail at the first element, what engages the provision to start with is a present entitlement to trust income. If there's no present entitlement to trust income, the section simply has no application. What this means is that in the ordinary course, Section 100A will have no role to play in relation to distributions of trust capital. If there are taxable capital gains that are distributed to a beneficiary as a capital distribution, then Section 100A simply can't operate because the first element isn't satisfied. However, even if the trustee enables a taxable capital gain to be included in the calculation of trust income, and whether that occurs automatically or on the exercise of a discretion by the trustee, there still may be no application of Section 100A. And that's because of the nuances of the modification of the rules in Division 6 by Division 6E and the rules in Subdivision 115-C in relation to the streaming of capital gains. Likewise, Section 100A might not have any application to franked dividends, to which a beneficiary is specifically entitled to and taxed pursuant to Subdivision 207-B. Subject to having amounts of trust income which aren't amounts to which the beneficiary is made specifically entitled, generally this element of 100A is fairly easy to find, but in some circumstances it might be more difficult, and East Finchley is an example of where it was difficult to find a present entitlement. So if we move now to the second element, there must be a reimbursement agreement. And this element is defined in quite a complex way in the provision, but it can be broken really into three different parts. First, it requires consideration as to whether there's an agreement. Now, the definition of agreement is found in subsection 13 of 100A, and that itself can be broken into two separate parts. The first part of that definition is a very broad inclusionary rule. Agreement is defined as being any agreement, arrangement or understanding, whether that agreement, arrangement or understanding is formal or informal, whether it's express or implied, and whether it's intended to be enforceable or not. So that part of the definition will capture almost any unilateral thought, although I do question whether you actually need two minds to reach an agreement, arrangement or understanding. But with that very broad inclusionary rule, I think it's very important for taxpayers to remember that any audit involving Section 100A is conducted with hindsight, and a particular course of action over time or a particular course of conduct may be sufficient to infer that there was the relevant kind of agreement. Now, there's nothing in the context of that definition or anything else in Section 100A that requires that the beneficiary be party to the agreement, arrangement or understanding. And the court in Idlecroft made findings to that effect. However, despite the very broad inclusionary part of the definition of agreement, there is a qualification or an exclusionary part of that definition. And that exclusion is any agreement entered into in the course of ordinary family or commercial dealing. Now, I'm just going to skip over that for a moment and Paul will talk to it shortly in a bit more detail. Once the arrangement is found to constitute an agreement, in order for it to be a reimbursement agreement, subsection 100A sub 7 requires that the identified agreement has to benefit someone other than the beneficiary who's presently entitled. Now, that can be by way of payment of money, that could include a loan, the provision of services or the transfer of property, anything that secures some sort of benefit for a person other than the presently entitled beneficiary. This component doesn't require a strict tracing, and there need not be any direct nexus between the present entitlement and the benefit. So as an example, if you had a trust with $1 million of income and one beneficiary was made presently entitled to that whole $1 million, but there was a benefit provided to some other person of $1, then technically Section 100A could apply to the whole $1 million. That ought not to be the case, and the Commissioner will never apply Section 100A in that way. And I'll come back to why that is in a moment when I talk about nexus. Now, the final part in working out whether you have a reimbursement agreement is that you also need to have a tax benefit. And this is a specific tax avoidance element of Section 100A, and it's found in subsection 8. What that means is the agreement must be for the purpose or a purpose or purposes that include a person not being liable to tax or being liable to less tax than would otherwise be the case if the agreement had not been entered into. And in the decision of East Finchley, Justice Hill stated that this requires a hypothesis to be formulated about what income tax would have been payable if the agreement hadn't been entered into. So, but for the agreement, would a greater amount of tax have been payable? There is a question about whether this requires a subjective or an objective purpose. And subsection 9 states that for the purposes of sub 8, an agreement should be taken to have been an agreement entered into for a particular purpose or purposes if any of the parties to the agreement entered into the agreement for that purpose and purposes. So it seems to be a subjective purpose that's required by subsection 8. However, for Section 100A, there is also a purpose requirement in the ordinary dealings exception, and Paul will come back to this shortly. So the notion underlying the definition of reimbursement agreement is the fact that the presently entitled beneficiary doesn't actually enjoy the income to which it's entitled, and the real benefit of the funds accrues to someone else in a more tax effective way. Now, the final element of Section 100A before we talk about the exception to the definition of agreement is there must be a causal nexus between the present entitlement and the identified reimbursement agreement. This element is required because the present entitlement must arise out of the reimbursement agreement or arise by reason of any act, transaction or circumstance that occurred in connection with or as a result of the reimbursement agreement. What the cases suggest is that the nexus requirement is a fairly low bar. but for the reimbursement agreement, would the present entitlement have arisen? But there's still a requirement to establish that nexus, and one can envisage circumstances where the nexus requirement simply isn't made out. So for example, if you take a beneficiary that's presently entitled to income in 1 year, but sometime later it's decided there will be something done which might be referable to that distribution and it benefits someone other than the beneficiary, in those circumstances, in my view, the nexus requirement isn't satisfied. Again, it must always be remembered that in the context of a dispute involving Section 100A, the taxpayer bears the burden of proof and they must be able to demonstrate that nexus doesn't exist. As I mentioned earlier, on a strict reading of sub 7, 100A could apply where there's a $1 million trust distribution but a $1 benefit provided to someone else. However, I said that ought not to be the case. The reason for that is the requirement for a nexus, which is found in sub 1 and 2, refers to that share or part of the share, and therefore any application of 100A should only apply to that part which benefits someone else and not to the whole present entitlement. So they're the key elements of Section 100A, but as I said, we need to go back to look at the meaning of agreement and more importantly, the carve out to that definition, which I've flashed over. So Paul, can you talk us through that exclusionary limb of the definition?
Thanks, Kaitilin. I can and I will. It's been written that the past is a foreign country and they do things differently there. Kaitilin has alluded to the context and express purpose of Section 100A's introduction in 1979. It was a child of an era we can now scarcely imagine, the bottom of the Harbour period in the late 1970s, when tax avoidance schemes were advertised in newspapers. Specifically, Section 100A was enacted to tackle what had been identified then as blatant trust stripping schemes. But Section 100A is drafted simply and broadly. It is not, on its terms, limited to schemes having features identified in 1979. That is, blatant and complex trust stripping where taxable income was matched with tax losses or exempt entities in unnatural ways that were devised by scheme promoters of tax schemes who were paid fees for putting it all together, that involved artificially created paper losses or merely sufficient deductible losses. So, at face value, it has work to do beyond its initially expressed mission parameters. The entry points may be circumstances involving distributions of trust income where cash flow or the movement of other assets is not aligned with the legal entitlement and where the enjoyment of distributed funds by the beneficiary is deferred or does not eventuate at all. As Kaitilin has noted, if a particular course of conduct was entered into in the course of an ordinary family or commercial dealing, it's not an agreement as defined and accordingly can't amount to a reimbursement agreement for the purpose of Section 100A. So, the notion of ordinary family or commercial dealing is the foundation on which the 100A edifice is built. But is it a foundation built on shifting sand? The initial observation that we make in relation to the exclusionary aspect of the definition of agreement is that what enlivens the exclusion is not the mere existence of or elements of an ordinary family or commercial dealing. So, on the one hand, it is not sufficient simply to show that there was a dealing between family members or a dealing between entities that were controlled by or for the benefit of a family, or show that the conduct occurred in a broader commercial context or that some steps in the impugned arrangements had commercial elements. But on the other hand, non-ordinary aspects of themselves will not necessarily be fatal. What must be demonstrated is that the conduct was entered into in the course of one of the dealings referred to, and those dealings were ordinary. In order to fall into the exclusion, you have to consider all the steps and components of the conduct or transaction to see if it is, on balance, explicable as an ordinary family dealing or as an ordinary commercial dealing. And remember, as Kaitilin has pointed out, the taxpayer has the onus of proving this. But here is the conundrum. What is ordinary and what is not ordinary? How does a taxpayer prove what is ordinary? Does the ordinariness have to relate exclusively to family dealing or commercial dealing? Or can you have a combination of both? A little bit of country and a little bit of rock and roll, so to speak. Despite its importance, the phrase ordinary family or commercial dealing is not defined in the legislation, nor explained really in the relevant extrinsic material, other than through examples referred to. Also, the few cases that have considered Section 100A, and there have only been 3 at the federal court level that have dealt with it substantively, do not provide any clear guidance really as to what conduct will be excluded and what will not. I don't think the Commissioner has to date, despite his best efforts and generally helpful efforts, provided any satisfactory or clear guidance either. But to be fair, it's not his fault. Prestige Motors, a decision of the full federal court, is perhaps the leading case on Section 100A. In broad terms, the circumstances in Prestige Motors involved the acquisition of control of a lost company and the utilisation of the company's losses by distributions of trust income. It was a complex scheme. As to the meaning of the term in the course of ordinary family or commercial dealing in subsection 13, the court noted that the wording of the exclusion derives from the judgment of Lord Denning in Newton's case, a 1958 Privy Council case involving the former Section 260. In that case, a contrast was made between arrangements implemented in a particular way to avoid tax and with transactions that are capable of explanation by reference to ordinary business or family dealing. The federal court in Prestige Motors acknowledged the dichotomy, that is, tax avoidance versus ordinary dealing, but it was not really taken any further than that. The court was not prepared to say that a similar dichotomy was a feature of the ordinary dealing test in Section 100A. As an opportunity to explain the meaning and scope of the exclusionary rule, what the court didn't say leave us disappointed. All we can glean, perhaps, from the cases is that an agreement that is not stamped as one entered into to avoid tax may be seen as one that was entered into in the course of ordinary family or commercial dealing, thus will not be subject to Section 100A. But that is, surely, an unsatisfactory basis for analysis. What is it, qualitatively, that stamps something with the badge of tax avoidance? What behaviour is ordinary, thus not tax avoidance? And what is extraordinary, thus is? Isn't it all a bit circular in the sense that you say it is not ordinary if it is tax avoidance, and it is tax avoidance if it is not ordinary? So, in subsection 13, we are required, it seems, to identify a tax avoidance purpose. Is that a different purpose to the one specifically referred to in subsection 8 that Kaitilin referred to? What's the measure? What factors should we balance? And I don't think we need to take into account Clint eating floor tiles as opposed to licorice here. But think about it. Dealings considered extraordinary in 1978 may be considered differently now. The extrinsic material from 1978 gives us a clue to those qualitative factors of an underlying tax avoidance purpose that is blatant and complex, devised by scheme promoters, involving a specially introduced nominal beneficiary and promoters' fees, etc., etc. This suggests, at least to me, a high bar, something higher than the subjective and simple tax reduction purpose test in subsection 8 that Kaitilin referred to. But the court in Prestige Motors also urged caution in relying on examples given in the extrinsic materials in order to read down the statutory language. So, where does that leave us? Look, what I think we can say is that the ordinary commercial or family dealings test is an objective test. After all, the concept derives from Newton's case, which dealt with the predication test under the former Section 260. In that case, it was held that in order to bring the arrangement within the section, you must be able to predicate by looking at the overt facts by which it was implemented, that it was implemented in that particular way so as to avoid tax. Also, how sharp does that purpose have to be? If there was a commercial or family purpose, does that purpose have to be the sole purpose, the dominant ruling or prevailing purpose, or just a purpose amongst other purposes? The context of the provisions suggests that it should be, at the very upper end of the spectrum, a solely egregious tax purpose one infers from the circumstances. The full federal court in Prestige Motors held against the taxpayer in that case on the inclusionary rules because it was obvious to the court that none of the transactions was entered into in the course of ordinary commercial dealing, and family dealing wasn't an issue there either. Thus, on the facts of that case, The court's conclusion seems right, but it tells us very little as to the content of the test. Is the best we can do something like, I can't define ordinary, but I know it when I see it? I hope not. And whose vision should we rely on? The Commissioner's? Other non-Section 100A cases offer us some clues, but leave no clear impression. Where else can we look? Part 4A, perhaps? We can see, expressed in the extrinsic material dealing with the introduction of Part 4A, I should mention a couple of years after the introduction of Section 100A, a notion that a scheme that was blatant, contrived or artificial, thus having the stamp of tax avoidance, could not be a scheme entered into in the course of an ordinary business or family dealing. Part 4A, you see, also had its roots in Newton's case. It may be that the central idea of artifice and contrivance is the only practical way of determining whether particular conduct has a stamp of tax avoidance and was not entered into in the course of ordinary family or commercial dealings and will be within the scope of Section 100A. I don't know. It may not be a bad proxy. It may be the only sensible proxy. Indeed, if one looks at all the cases that give us clues as to what ordinary dealings mean, where the taxpayer was not successful, the schemes in question could be characterised as ones that had obvious signs of blatancy, contrivance and artificiality. But the problem remains that with Section 100A, unlike Part 4A, we have no objective prescribed standards against which we can assess whether a set of circumstances are or are not ordinary commercial or family dealings. As we've seen from the cases, Section 100A has been applied in circumstances where you think it should have been applied. The circumstances in the three main Section 100A cases, Prestige Motors, Idlecroft and Raftland, were all blatant, artificial and contrived, and egregiously so. But, like beauty, notions of artifice and contrivance are in the eye of the beholder. Kaitilin, let's go through some examples.
Thanks, Paul. So we're going to go through 3 case studies. They're very simple case studies, and in each case, it's our view that Section 100A doesn't apply. Now, this first case study involves a father who wants to give some money to his daughter for if and when she might need it. Of course, one option would be for him to give it to her directly, but another may be to do so through a trustee controls. So that being the case, the trustee makes the daughter presently entitled to the income of the trust, being $20,000, but the trustee won't pay that amount all at once, but it creates a legal entitlement to that trust income. So if we think about the elements of 100A, there's a present entitlement, tick. Is there an agreement? Probably. There's probably some discussion between the father and the daughter. I'm giving you this money, but don't call on it unless you need it. Perhaps there's a discussion about it between the father and the accountant. That might amount to an agreement. We'll come back to the carve out of the definition of agreement at the end. If we think about the other requirements for a reimbursement agreement, someone other than the daughter is benefiting from the use of the cash because the trustee can keep that cash until such time as the daughter requests it, and there is the relevant tax avoidance purpose. As I said, the father could have given the money to her directly if and when she needed it, and if that were the case, more tax would be payable than in the circumstances of the case study. So subjectively, the purpose of this arrangement is that less tax is payable than if the agreement hadn't been entered into. We then have to ask whether there's the relevant nexus. But for the reimbursement agreement, would the present entitlement have arisen? Probably not. So as you can see, we're ticking all the requirements of Section 100A. But did the agreement arise in the course of an ordinary family or commercial dealing? Even in this very simplest of cases, a case that arises very regularly, the only way for Section 100A not to apply is to rely on that ordinary dealing exception. Now, in our experience, the ATO have never applied Section 100A to these types of circumstances. And Section 100A ought not to apply when a trustee makes a choice under a trust deed to distribute income to one beneficiary or another, even knowing that that choice might have a different tax outcome. But the purpose of this case study is to show the surprising potential reach of a Section 100A, subject to the application of the ordinary dealing exception. If we have a look at the next case study, in this case study, there's a loan from a resident trust estate to a private company on which the trust derives annual interest income of, say, $100,000. And we can assume that's the only income of the trust and there's no expenses of the trust. So in a particular year, year one, the trust makes a non-resident beneficiary presently entitled to the interest income. Because she's a non-resident, there's a 10% withholding tax payable, and as is the case with most trustees, the trustee can pay the withholding tax out of the distribution to the beneficiary. So let's assume that the remaining amount after the withholding tax is paid is actually paid to the non-resident beneficiary. Now, sometime later, say in year 3, the non-resident's brother, who also controls the trust, is also the CEO of the private company and draws quite a substantial salary from that company, wants to do some renovations of his house. Let's say his sister, the non-resident beneficiary, loans him $90,000. What then of the elements of Section 100A? There's a clear present entitlement. If we think about the first part of the definition to agreement, yes, there's an agreement within the statutory meaning, there's a loan. We'll come back to the ordinary dealing exception. Does someone else benefit in the terms of subsection 7? Here, there's a loan to someone other than a beneficiary who's presently entitled, and that's a sufficient benefit. What about the tax avoidance purpose? Is the reimbursement agreement for the purpose that includes a person being liable to tax, less tax than had the agreement not been entered into? So in other words, but for the agreement, would more tax be payable? Well, if you think about this case, on the distribution to the non-resident, you have withholding tax of 10%. The alternative, assuming the flow of funds would be the same, is that the resident brother would have been presently entitled to the $100,000 of income, which would have been subject to a much higher tax rate. So the tax avoidance purpose is there. What about nexus? In the circumstances of this example, I would say the nexus requirement isn't met. The present entitlement didn't arise out of or by reason of the reimbursement agreement. But you can think about possible scenarios that might change that. What if there was a temporal connection between the making of the present entitlement and the loan? Is that sufficient to have a nexus? What if this occurred year on year? Would those sorts of factors be sufficient to give rise to an inference that the nexus requirement is met? So coming back to the ordinary dealings exception, the exclusionary part to the definition of the agreement, is this agreement entered into in the course of an ordinary family or commercial dealing? On the very simple facts of the case study, we don't know what the Commissioner's view would be. Now, the ATO has guidance on their website on Section 100A, and his view is that where you have a loan on what he articulates to be commercial terms, so for example, requiring payment of principal or interest over time, the ATO wouldn't seek to apply Section 100A in the absence of other factors. We can perhaps infer from that is because he would consider it to be an ordinary commercial dealing. But what then about an interest-free loan, an at-call loan, what the Commissioner might ordinarily term perhaps an uncommercial loan? He hasn't provided any guidance on that. But in my view, there's nothing particularly unusual about making interest-free at-call loans within a family group. In fact, that's the norm within a family group. This type of arrangement is one that occurs in an ordinary family dealing, and the exception should apply. An interest-free at-call loan isn't artificial and it isn't contrived. It's not something to which 100A ought to apply, and we'd hope the Commissioner would take the same view in any ruling he might release on 100A. So our final case study has to do with a corporate beneficiary. We have a family trust that's made a private company presently entitled to trust income, but all entitlements have remained unpaid. Now, some of those entitlements might have arisen pre-December 2009 and some after, but all the unpaid present entitlements here have been converted to a common law loan and are on Division 7A terms. Again, if we think about the elements, there's a clear present entitlement. If we think about the first inclusive part of the definition of agreement, well, that's satisfied, and we'll come back to the ordinary dealings exception. Does someone other than the beneficiary made presently entitled benefit? Yes, the trustee has the benefit of the loan from the private company and can use those amounts for its own purposes. But for the agreement, would more tax have been payable? Yes. On the facts of the case study, a tax rate of 30% is applicable, but for that agreement, in order for the trustee to retain use of the funds, it would have needed to make no beneficiary presently entitled, and then we're looking at paying the highest marginal tax rate. What about the Nexus Requirement? Now, in various presentations by senior tax officials, they've indicated that Nexus is likely to exist where there's a pattern of behaviour. So perhaps we have a Nexus here. But what about the ordinary dealing exclusion from the definition of the term agreement? The ATO's current guidance on its website in relation to Section 100A includes an example of this type of arrangement. And the ATO's guidance says that where funds are lent back to the trust under a Division 7A complying loan and retained by the trust as working capital, the ATO would, in the absence of any other factors, not consider this arrangement to be a reimbursement agreement. It's our view that that's correct, and it's correct because where you have funds lent back to the trust on Division 7A terms, it falls squarely within the ordinary dealing exception. Now, these are very simple examples just to illustrate some of the elements of Section 100A, and that they can be ticked off quite easily, or at the very least it can sometimes be quite difficult to prove that the elements aren't made out. Of course, the other challenge in these simple examples is that in order to prove Section 100A doesn't apply, you often need to rely on that ordinary dealings exception. And as Paul's mentioned, the authority on the scope of that exception is quite scant. But as I've articulated, Section 100A ought not to apply in each of those examples. So I'll hand back over to Paul just to conclude and to perhaps let us know what's in store in relation to 100A.
Thanks, Kaitilin. Look, for my part, I think the provision should have been repealed years ago, but it hasn't, and here we are. Section 100A can invoke mixed feelings. On the one hand, perhaps beguiled by the economy of the drafting and the provision's age, it may lead to a casual indifference. On the other hand, having proper regard to the drafting, perhaps the genius of it, Section 100A may lead to feelings of fear and loathing. A more balanced approach is possible, I think. Informed by experience, I tend to regard Section 100A with cautious optimism. Up to now, it is a weapon the Commission actually uses less than one might think. I think that infrequency is not, how should I put it, an indulgence on the part of the ATO, but a proper reflex of how the section should be applied. Having regard to the cases and the rulings, and generally speaking, Section 100A has tended to be applied or not applied by the ATO in circumstances where one would think that was the proper outcome. That's not helpful, of course, but it does, I think, foreshadow the difficulty in setting the boundaries of Section 100A's scope. That the ATO is indeed, for the first time in 40 years, seeking to draw that boundary with greater certainty and clarity. An ATO ruling on Section 100A has been in development since October 2018. The project was put on the back burner at the start of COVID as the ATO prioritised other issues, but this and other guidance products are coming out of hibernation. According to the ATO website, the proposed ruling is intended to set out the Commissioner's preliminary views on the exclusions from a reimbursement agreement for the tax purpose that Kaitilin referred to in subsection 8, and secondly, and perhaps more importantly, the question of whether agreements are not agreements because they were entered into in the course of ordinary family or commercial dealings. Once that ruling issues, will our immediate past be a foreign country where thoughts and actions prove to be different to what the Commissioner sees in the future? Well, we'll see. Look, it must be acknowledged that there is a real challenge here for the ATO in substantively addressing this old provision in a ruling for the first time in 40 years, made all the more difficult by the fact that its key controlling concepts have no statutory or objective meaning. It has been substantively considered by an appellate court on only 2 occasions. There have been a number of subsequent statutory rules that have overlapped or overtaken its possible operation, and it is a provision which the ATO has, at least in our experience, largely improperly deployed sparingly and with restraint. I don't know what the ATO has in store, so I can only offer my own suggestions for principles that might guide the development of the ruling. 1, the administrative restraint generally practiced to date should be maintained. What should continue to be picked is the fruit higher up the tree. Second point, this will affect a lot of taxpayers. In a report on trust prepared recently, it was observed that by 2022, it was expected that over 1 million trusts will exist in Australia, and most of those will be discretionary trusts. We know that the extensive and legitimate use of trust spans the spectrum of economic activity from micro businesses to the very largest of private groups. Whereas not all trustees of trust in Australia will create present entitlement to trust income each year, I imagine many will in relation to multiple beneficiaries. It's not difficult to see then how critical a ruling on Section 100A will be to millions of taxpayers who have, to date, been spared its menace. This ruling is a milestone project for the ATO, taxpayer and advisors. In some very practical ways, it is not just a guidance project. For all intents and purposes, the ATO will be making the rules here. This project will be best served by strong, productive and measured consultation and consideration. There is much at stake for taxpayers and the fair administration of the tax system. The third point, Section 100A was Parliament's response to egregious trust stripping schemes. On its terms, it may operate more broadly, but the requirements of a subjective tax reduction purpose, the exclusion of ordinary family or commercial dealings from the definition of agreement, and the absence of any limitation on the Commissioner's ability to issue assessments all indicate that the section ought only be applied to conventional trust stripping, such as that in Prestige Motors, Idlecroft and Raftland, or other similar egregious arrangements. The point is that there should be a high bar of entry for Section 100A. Finally, if the ATO's ruling amounts to a change in how it applies the provision, it must have prospective application. Let us hope that after 40 years, the ATO will be guided by the better angels of its nature. Clint, over to you for questions and if there's anything further.
Thanks, Paul. I'm conscious of time and we want to stick to our sterling record of keeping these to the 45 minutes. We've had some excellent questions through, so thank you to those who have sent them through. There's a couple we might touch upon quickly before we wrap up for the day. The first question, maybe if I can direct this, I think to Kaitilin, is can Section 100A operate if there is a fully franked dividend derived by the trust which is paid to a non-resident beneficiary?
Thanks, Clint. It's a good question. When you have a non-resident beneficiary presently entitled to a dividend, they're deemed to have derived income consisting of that dividend at the time they became presently entitled. The same applies to non-resident beneficiaries that are presently entitled to interest or royalty income, and that arises by dint of Section 128A. And the trustee will be liable to pay withholding tax on that dividend, except to the extent it is franked. Now, let's just assume that this franked dividend to which the beneficiary hasn't been made specifically entitled. So we're only in the ordinary Division 6 rule. In those circumstances, I think it's possibly arguable that 100A could be applied, provided all the other elements are met. There was a presently entitled beneficiary that's not under a legal disability, but you still need to show that there's a reimbursement agreement and the relevant nexus exists. Now, the Tax Office has had presentations in the past where they've suggested that 100A would apply to fully franked dividends paid to a non-resident beneficiary. But the problem with 100A and the examples, and perhaps why the ATO has to date given very simple examples in its guidance, whether that's on the website or publicly, is that it's very difficult to provide guidance on the application of 100A where you're judging it based on, as Paul mentioned, based on subjective criteria. There's no objective criteria like some of our other anti-avoidance provisions.
Thanks, Kaitilin. Maybe we've got time for one more. Another one's just come through that I think is a good one. Maybe if I can throw this to Paul, questions come through about the interaction of Section 100A and pre-2009 UPEs or unpaid present entitlements. Paul?
Yes, thanks, Clint. What about them indeed? The Commissioner's position on his website in relation to that very scenario is vexing. his view is, as Kaitilin pointed out, in relation to post-December 2009, what's referred to as unpaid present entitlements, that if they're put on Division 7A terms, or there is a, PSLA, 2010/4 investment agreement in place, he'll regard that as being something done in the course of an ordinary commercial or commercial dealing, and therefore it won't be caught by Section 100A. Now, what he says about the pre-December 2009 UPEs is that he will not devote compliance resources to those scenarios. Now, that's not an unusual course of action for the Commissioner, but it's unsatisfactory because my view is that something like that clearly falls within the exception, or ought to fall within the exception to the definition of agreement, because it's about as ordinary as you can possibly get in the circumstances, and leaving just simple scenarios of where you have those UPEs that may have been set aside for 20, 30 odd years. There ought to be no place whatsoever for 100A to apply in those circumstances.
Okay, well, thanks, Paul. I think we'll leave it at that, and we'll all wait with bated breaths to see what shape that further guidance and ruling from the Commissioner comes out, and hopefully it contains some fairly realistic and useful examples to help us navigate some of the issues you've talked about today. So I might close by thanking both Paul and Kaitilin for a very valuable summary of these provisions. As Paul mentioned, we deal with and engage with the ATO about these provisions very frequently, and it's very clear that there are perils in the shadows within these rules. And of course, don't forget the sting in the tail that the Commissioner has an unlimited amendment period to assess under Section 100A, as Kaitilin said. We have in the pipeline one further September tax webinar for those that are interested. Zoe Chung and Mark McRae will present next Wednesday on New South Wales and Victorian state taxes and some topical issues to do with FIRB. So thank you all for attending this ABL webinar. Stay well, stay healthy, watch some Dukes of Hazzard just to keep that link with 1979. And we hope you will join us again next week for the next webinar. Thank you very much.